Good morning, everybody, and greetings wherever in the world you are. My name is Claire Shine. I'm the CEO at the University of Cambridge Institute for Sustainability Leadership, or CISL. CISL works at the frontiers for a sustainable economy, one that works for people, protects and restores nature, and accelerates decarbonisation. Right from the start, we've worked at the nexus of business, finance, and government, building on cutting-edge education and research portfolios. As you know, the nature-climate emergency is a systemic challenge. It affects every aspect of the finance industry, and it will require massive upscaling of risk sharing and management across populations, generations, and economies. The IPCC Sixth Assessment Report saw the world peaking at 1.6 degrees in the most optimistic scenarios. And that means that measures to drive adaptation and resilience have got to be an urgent focus for the whole industry, especially insurance, given how many of the costs of inaction on climate change will be borne by this sector. So CISL's Centre on Sustainable Finance works with banks, insurance and investors across the whole financial space. And we aim to help them, to help you, play an active and responsible role in driving the necessary change at scale. We use the university insights and rigor to address the knowledge gaps and develop tools that are really usable and practical for your practitioners working through co-creation. And the three leadership groups that we have, ClimateWise, the Investment Leaders Group, and the Banking Environment Initiative, are increasingly coming together to think through that systemic lens about how we can have the kinds of tools that really enable us to accelerate our positive impact. Many of you will know that ClimateWise was a pioneering group in this sector. We now have nearly 40 members from across the insurance value chain. And we're always seeking to show, as I mentioned before, how insurance can drive that transition in the wider finance industry and the economy. We enable and encourage best practice climate reporting, and we support firms to show how they can deliver on climate commitments, to unpack the notions, for example, of net zero underwriting and showcase tools. And I'm going to give just one example, which is hot off the presses, hot off the virtual presses. Yesterday, our ClimateWise group with partners published a landmark publication at COP26, I'm sitting in Glasgow now, called Risk Sharing in the Climate Emergency, Financial Regulation for a Resilient, Net Zero, Just Transition. And that report identifies 20 concrete actions that will drive meaningful change. And I've heard it described by Dominic Christian, Aon, as the most significant publication, the most significant Bible for the industry going forward in decades. So I'm very proud to see this collaborative knowledge sharing work that we are part of with the kind of partners who are joining us today. We have a very rich agenda and some superb speakers. So with that, I want to pass on immediately with the great pleasure of introducing a video from Andreas Brandstetter, who, as you will know, is the President of Insurance Europe. So with that, I thank you for joining us today, and I'm delighted to see this critically important conversation happen, albeit early in the morning. Thank you, and over to President Brandstetter.
Good morning, ladies and gentlemen. It's my big pleasure to address you at this important event, which will focus on the significant role that us insurers and banks play in supporting the transition to sustainability. The need to act in relation to climate change has never ever been clearer, and the COP26 summit represents a key opportunity to agree on more ambitious targets and actions. Let me now turn to insurance. Let me turn to our industry. I want to share three thoughts with you. First, climate change and the role of us, of the insurance sector. Given our dual role as, on the one hand, risk underwriters and on the other hand, as long-term investors, us insurers already contribute to both the fight against climate change and the transition to sustainability. As underwriters of natural catastrophe risks, us insurers are acutely aware of the risks posed by climate change. Weather-related natural catastrophes can already cause hundreds of billions of euros of damage in one single year. And they are increasing in frequency and severity, and this trend is expected to continue also in the future. Therefore, it's vital that actions are strengthened to both, on the one hand, minimize climate change overall, and on the other, adapt our societies to an already changing climate. This, of course, as we know, requires coordinated action involving both the public and private sectors, including, of course, us insurers. So, what in concrete are we doing? To help our society to adapt, insurers can contribute to a more, I would say, holistic understanding of climate-related risk through our modeling capabilities. We can also assist policymakers in guiding society much better towards adaptation practices with tools such as risk zoning and mapping and land use planning. As Europe's by far largest institutional investors, with over 10 trillion euro of assets under management, we as insurers can help finance the transition toward carbon neutral, climate resilient, and of course more sustainable economies. And as underwriters, we can use our underwriting policies to incentivize our policyholders to transition to greater sustainability. Second thought, Insurance Europe and its role in the coordination. European insurers also lead and participate in many sustainability initiatives and coalitions. This includes global frameworks, for example, the UNEP-FI principles for sustainable insurance and principles for responsible investments, as well also as other UN-convened alliances like the Net Zero Insurance Alliance and the Net Zero Asset Owners Alliance, which Insurance Europe has recently joined as a strong supporter. Insurance Europe is also creating a sustainability hub on its website, which provides a lot of information about how Europe's insurers contribute to combating climate change and its effects. This hub aims to share best practices across our sector and illustrate how us insurers can help to meet sustainability goals. My third thought is about the conclusion. So there is a lot already going on, and our industry is very keen to contribute much more in future. Yet, insurers and the financial sector alone cannot bring about the necessary changes to address climate change and the move to a truly sustainable approach. Sustainability is a shared responsibility. To achieve this, all stakeholders involved, including citizens, industry, policymakers, must take action together, jointly. So today's event will be an opportunity for our distinguished panel to discuss the role of banks and insurers in the transition to sustainability and how, through their various sustainability-related actions, activities and approaches, how they can help reach ours, Europe's sustainability goals. Thank you.
Ladies and gentlemen, good morning. And indeed, it was what Mr. Brandstetter said. This is an opportunity where we should all come together. Banks are, in my view, an important part of the solution. We are all, everybody, very aware of the state of our planet and the urgency that we need to act. If we want to save our future, an urgent shift from both private and public sector resources towards a low-carbon economy is essential. Financial institutions are not only the ones going to be impacted by climate change, they're also a part of the solution by financing the economy. Banks financing in support of the goals of the Paris Agreement will make a big difference in terms of reducing and mitigating the impacts of climate change. We will be discussing further today the role of financial institutions and how banks and insurance companies are engaging with their customers in advance of transition. No, we cannot do it alone. But let me be absolutely clear. Banks will be judged and banks will judge. So the easiest way to go to a low carbon balance sheet for banks is actually to kick out all the clients that have brown activities. But that is not the way forward. The way forward is to be ambitious in helping with the transition. Banks need to shift their resources towards a low carbon economy, and that is key in financing the transition. We cannot expect finance to make this shift in the absence of major change in incentives on the underlying economy. We cannot tackle the climate crisis and we can only tackle the climate crisis through collective action across public and private sector. This progress is heavily dependent on government delivering their action plans and industrial strategies, because we need goals, benchmarks, and objectives to help with the transition. More than 80 countries and 70% of the economy is committed to net zero, but most national policies are not aligned with the target, in particular the terms of the intermediate targets, how to get from A to B. We need the clarity and predictability on policy actions. But first and foremost, we need greater national political ambition to align the underlying economic incentives with the Paris Agreement. Climate change is a global issue and requires global solutions. The EU contribution to global carbon emissions is around 8%. While essential and fully supported decarbonization of the EU economy itself will not have the material effect on climate change that we need. So we need not only to turn inside, but also focus outside and provide expertise and resources also to developing economies if we are to guide and lead the transition to net zero. Nearly a quarter of EU banks' exposures are to entities outside the EU. So global cooperation and harmonization are key to prevent market fragmentation, greenwashing, and other negative effects. COP26 is an important and the right platform for discussion on how we can reach international harmonization and standardization to facilitate the flow of capital where it's most needed. We need to work together urgently to decarbonize sectors that contribute to global emissions, such as heavy industry, manufacturing, agriculture around the globe. Companies need to start disclosing their transition plans and other relevant forward-looking information. And governments need to define official underlying transition paths per sector and geography. Based on this, and you say that I talk to governments and companies, but that means that we as banks, on the basis of these data, can evaluate the robustness and the credibility of the company transition plans. And that is the way to really go to net zero. So it is a great pleasure to introduce Eric Usher, the head of UNEP FI. As part of the Glasgow Financial Alliance for Net Zero, UN convened an industry-led initiative, the Net Zero Banking Alliance. This alliance brings together banks representing over a third of global banking assets, and these banks are committed to align their portfolios with net zero by 2050. And indeed, if we can do better, always that is better. They will be setting intermediate targets for 2030 or even sooner based on robust science and in a transparent and publicly accountable way. At the European Banking Federation, we are very proud to be first official supporter, and in that way we commit to further steps to accelerate the banking sector's transition to net zero. I am looking forward to work closely with Eric to pursue our joint ambitions, but now I would like to listen to Eric's remarks. Eric, you have the floor. Thank you very much.
Well, thank you very much, Wim, for the kind introduction, and a pleasure to be with you all today in a very, very busy period. Thanks to Insurance Europe, to the EBF, to ClimateWise and CISL for bringing us together virtually, which is the way we're more and more learning to work. And in many ways, it's actually making us more productive, I think. So it's really a pleasure and I think an urgency to be speaking, and with the backdrop of COP26 going on now. It's been dubbed the finance COP, I think, in recognition of the crucial role of the global financial industry in really being a key actor in helping deliver on the goals of the Paris Climate Agreement. Yesterday, which was dubbed Finance Day, was really quite significant. And let me reflect on some of the progress. And I would highly suggest people to go and watch some of the sessions, and a very powerful speech from Mark Carney and leaders from the IFRS, from the FSB, from essentially all of the contingent parts that we need to put the puzzle together to get to where we all know we need to go. It's clear that global financial markets have the potential to really bridge the sustainability gap by linking financing needs to the global sources of funding. Analysts project that we need about $4 trillion US to be invested in annually in decarbonizing the global economy, let aside the building resilience. So I think the scaling up the sustainable finance worldwide is really challenging, for which market guidance is necessary to steer capital flows in this environmentally sustainable direction. We need coherent definitions of sustainability across jurisdictions and a higher increasing degree of standardization and transparency. And the data question will be key to much of this. UNFFI, as Wim kindly has mentioned, we are a partnership between the UN and 430 global banks, insurers, and asset managers globally, working very closely as well with the PRI, which we established back in 2007. And we also have 100 supporting institutions, such as the EBF, and we're working closely with groups like Insurance Europe, as we've heard. Really helping to see how do we embed sustainability considerations into financial practice. We principally work through 3 frameworks: the Principles for Responsible Investment, which I mentioned, the Principles for Sustainable Insurance, and the Principles for Responsible Banking. Now, these are norms that have clearly set the ground for a better sense of purpose within the financial industry and a heightened understanding of what common action and private leadership for sustainability really means. The PRB, as an example, we just celebrated our 2-year anniversary of the Principles of Responsible Banking with a release of the first biennial progress report from this community of responsible banks. Now it's 250 strong, together accounting for more than 40% of global banking assets, serving 1.6 billion people. Therefore, this isn't, and this agenda is no longer a little green club, but rather this is a much wider industry mobilization. And we're seeing these frameworks for essentially, or the urgency to be able to align a bank's business with societal objectives, like the Sustainable Development Goals and the Paris Agreement. I would point out that BBVA was part of the global group of 30 banks that drafted the principles back in 2018, and the EBF, European Banking Federation, also has been an early supporter, as Wim has mentioned. Meanwhile, the Principles of Sustainable Insurance actually will be celebrating its 10th anniversary next year, which really has been focusing on refining what the purpose to better understand, prevent, and reduce ESG, environmental, social, governance risks across an insurer's business, and to better manage the opportunities to provide quality and reliable risk protection. Of course, insurers, as I pointed out, are also investors, and they really have a critical role to play through actually the 3 functions of supporting the management of risks, the underwriting of risks, and the investing in companies who hopefully will come together to provide some of the solutions there as well. I think moving to the COP now, particularly what happened yesterday, the net zero commitments, I think, are now clearly the next step regarding financial institutions' climate action. Climate disclosure, the Task Force on Climate-Related Financial Disclosures, the TCFD, I think it's been for many the first step, and really good progress has been made since Paris, since 2015 when it was launched. I think also, besides disclosure, there's been a lot of development in terms of green finance innovations, and many have been issuing green bonds, or in some way putting the toes into the ocean, as we can say. But I think disclosure and some green finance transactions at the margins is not nearly enough. We need to really be thinking much bigger, much more holistically. And I think now it's no longer about green transactions, but about fully green institutions and portfolios. And of course, in a climate context, this means zero carbon institutions portfolios. Net is part of that, but zero is the focus. Net is the supporting function. in the run up to COP26, we've seen the GFANs led by Mark Carney making very significant progress, and the work undertaken by all the net zero involved alliances, including the three that UNEP-FI is privileged to help convene: the Asset Owner Alliance, the Net Zero Banking Alliance, and the Net Zero Insurance Alliance. I think this is a critical example of what it means to talk about green in the whole organization, not just focusing at the margins. Yeah, a couple of words on these alliances. The Asset Owner Alliance, launched in 2019, was the first significant finance sector coalition of the willing, if we can say. They just issued their 2-year progress report. And most importantly, 29 of the founding AOA members have now issued their 2025 targets. We know 2050 is okay as a light on the hill, but it's really what we do today. And what we do today is dictated by where we need to be in this business cycle. These reductions that have been issued for 2025 are roughly in the 25% down reductions range. Some of them go quite a bit further. The UN Secretary General has termed the Asset Owner Alliance as the gold standard of net zero initiatives. Talking about now net zero banking, wow, there's been a lot of mobilization. We're going to hit 100 signatories, I think maybe during COP. Already, we're at 43% of global banking assets covered. The top 10 banks in Europe are members. Now, maybe that's not surprising. Well, as I'll talk about, Europe is often in the lead. But I think much more remarkable is today, as of a week ago, Goldman Sachs joined, which means the top 10 North American banks are also on board. The top 6 of 10 Latin American banks. And more. So this is a global phenomena. Europe is often at the lead, but as we know, unless others come along with, we won't get to where we need to go. Asset Owner Alliance, I should point out, the fastest area of the growth today is actually in Japan. So Europe got it started, but other important markets are coming along with. To my knowledge, in terms of the Banking Alliance, the first 2 banks who have issued their interim targets for 2030 are BBVA, which issued in, I think it was yesterday or just in recent days, and Morgan Stanley. So once again, leadership is spreading geographically and more. We're going to hear shortly from Renaud Guidet, who chairs the Net Zero Insurance Alliance, and to talk about the important progress there. And for insurance underwriting, there's a lot of work to be done. I think we can acknowledge that insurers have been in the lead on this agenda, but largely initially through the investment angle, including through the Asset Owner Alliance. Now the catch-up is happening in terms of underwriting, and Renaud is going to go into that in more detail. So I think through these alliances, financial institutions really are stepping up their leadership role on defining on the defining issue of the century. And, the relevance of these approaches is that they go beyond a mere risk management assumption and sort of near-term definitions of outside-in financial materiality. We've really shifted towards a double materiality, or as some would describe it as a dynamic materiality context. At COP26, we see how the pressure for action has not stopped rising, and it will continue to do so. And I think today in the session, we really appreciate the EU Pavilion giving access to essentially how do we learn from what's happening in Glasgow for what it means for our industries. I would like to talk a little bit about the really important interconnection between voluntary action and the role of regulators. And, critics, sometimes would basically say voluntary action on the part of the private financial sector, is it, some would even say greenwashing. For instance, in ESG labeling and commitments to net zero, there have been some regulatory investigations that have been started. And I think one of the real problems with that point of view is it doesn't understand that we in UNEP-FI, and I think many actors around the table, do not believe that this is it's either private or public who needs to solve the problem. We need to solve it together. And I think this leaning in from the private sector is really critical to help regulators come in, not to basically say that their role isn't needed. And so we really believe in the role of voluntary action financial sector. We call it sort of the leading in or change-making ambition of leading banks, insurers, and investors. It's not a replacement for regulatory action, but it's rather an expected precursor or a core ingredient to it. This relationship, it's not a step function. So it's not about waiting, financiers waiting for a price on carbon to start engaging. It's more of what we describe it as a dance whereby each party makes a move that then signals the other to respond, building trust and the ratcheting ambition that the Paris Agreement was designed to foster. I think we've seen this in various different lenses. The TCFD is a really good example. It's voluntary, private sector has initiated, but we are seeing regulators now coming in to ratchet up to improve the quality of disclosures. But the broadening of disclosures really has come through voluntary action. We've worked extensively with our membership to help them get started in helping create the norms about how you can start to report in these areas, but we also really appreciate the role of regulators, including in the EU, including in the UK, and as far away as New Zealand, to basically say, okay, now we need to start to ratchet up, and some mandatory aspects to disclosure will be needed. So I think this public-private progress being made on climate risk disclosure and also the really important role of taxonomies, we really help ratchet ambition to a new level of activity, comparability, and credibility. With this, the financial sector really can credibly lean in to the challenges that we know are significant, but you can become, as we call proverbial change makers, and know that your voluntary leadership will not only position you for the sustainability transitions, but also help catalyze governments to join this dance and create the conditions where the laggards have no choice but to also join the fray. We heard quite a call from Larry Fink from BlackRock yesterday about this problem between public listed markets and the private markets, and that we can't create an arbitrage where public actors just pass on assets to those who maybe have less transparency and maybe less compulsion to address environmental sustainability challenges. So I think European financial institutions have been some of the most active globally, coupled with really active regulator coming out of Brussels. I think together creating the advanced jurisdictions of this space. And I would call out the work of the EU, starting with the H-leg several years ago, the ground setting action plan on sustainable finance, which really has made important progress to enhance standardization, with some clear definitions of what economic activity can be considered environmentally sustainable. This European ambition is accelerating, with concrete action, such as agreeing on technical screening criteria for sustainable, on market standards, definitions, disclosures, and I think all of the relevant aspects of what we need to make sustainable finance an actionable and investable reality. The EU strategy for financing sustainable growth from July of this year really looks into more concrete ways of financing the transition to sustainability, to inclusiveness, and to the financial sector's resilience and contribution to sustainability and fostering global ambition. This EU taxonomy really continues developing and evolving, and we really appreciate the relationship with the EBF and UNEP-FI working together with our European banking members to test it out and to provide inputs on how to make further improvements. We have the EU platform on sustainable finance, which is working to expand definitions and clarify scope, and the international platform on sustainable finance, which is working towards a common ground taxonomy. How can we get that this is not a European thing, but this is becoming increasingly global? We have our UNEP-FI European Regional Roundtable next week. And I think we're going to delve into a lot of these issues in more granularity. And there's a lot to be learned, and there's a lot to be shared amongst Europeans, leading actors. I would really like to encourage everyone listening today, please take the sustainability challenge that we all face very seriously. Let's work together collaboratively and with your clients, with regulators, in order to deliver the most results-oriented outcomes that can prove, we believe, beneficial to all. With that, I'd like to conclude. I'm sure the discussions that we're going to have today are going to be explored in more detail, and really appreciate the opportunity and looking forward now to shifting to listening mode. Thanks, and back to Nina. Thank you very much.
Thank you very much, Eric, for the kind introduction. My name is Nina Sinke. I'm a research director for the Center of Sustainable Finance at the Cambridge Institute for Sustainability Leadership. It's my absolute pleasure to host this panel discussion from Glasgow. And we have heard so much about the importance of collaboration. And I think it's absolutely fantastic that within this discussion, we have representatives from the insurance sector as well as the banking sector.
And I think those two sectors really do need to work together much more productively if we are to enact a transition towards a net zero and a nature positive economy. After all, that is why major financial regulators in their climate stress tests have actually started doing that together between both of the sectors. So without further ado, let me introduce our absolutely fantastic panel. We're joined today by Allegra van Heuvel-Patrizi, CEO of Even in the Netherlands, Renaud Guidet, Group Chief Risk Officer AXA and Chair of the Net Zero Insurance Alliance, Hasina Pai, Chief Sustainability Officer of Société Générale, and Carl Oscar Olman, Chief Sustainability Strategist at SEB. So if I can please invite you to kick off our conversation by providing kind of maybe a 1-minute sentence introduction of how your organization is actively contributing to net zero transition. Let me start with Allegra, please.
Thank you, Nina. Thank you, everyone. Look, I think this is one of those crucial moments in history, a little bit like when they started creating the railroad systems across the different continents in the 19th century. And that essentially means that this is the moment where we all need to come together. As has been said by some of the people before, but it's really the moment where we need to stop vying for attention, for posturing on a single name basis, and actually put our strengths together, stemming from insurance and banks, but not only. It needs to be the larger system, including governments, including all private actors. Because let's be honest, this is not about one company winning at this game. This is about we either all win or we all fail. The planet is one ship for everyone.
That's a fantastic start. Renaud?
Thank you, Nina, and good morning to all of you. I hope you're doing well. In 2015, AXA was the first insurer globally to exit coal. And by acting as a pioneer and by leading the way, we also wanted to be a driving force for the rest of the industry. And this is why later on in December 2020, last year, we called for the creation of an alliance of like-minded insurers and reinsurers, which led to the formation earlier this year of the Net Zero Insurance Alliance, which I am honored to chair, and which gathers players which are determined to transition their carbon footprint and their underlying portfolios to net zero by 2050. AXA also took a very recent step, which you may have seen last week, which is that we announced that going forward, we will no longer invest in nor underwrite any new greenfield oil exploration project unless it is supported and carried out by a credible transition leader. And I think that is testimony to AXA's approach, which is two-pronged. The first one is that we want to rely on scientific evidence, and definitely that ties to the no new oil mantra that was put forward in the report that was heavily commented on by the International Energy Agency earlier this year. And we want to make sure that we stick to credible scientific references to avoid greenwashing and to be as transparent, as credible and credible as possible. And the second pillar of our approach is that we want to be inclusive. We want to support our clients in their transition effort. The idea is not to just churn them out and be an exclusion machine, because then you have a better conscience, but the planet is none the greener. The idea is to make sure that we can, be in the tent with our clients, with their brokers, and from the inside, transform their manufacturing processes, their logistics processes, that's their service providing processes. And just like, for coal earlier and for other underwriting restrictions, we could act as a driving force and we were followed by the rest of the industry. We very much hope that this latest move by AXA will be mirrored by many others, because it has to be a collective success.
Thank you, Renaud. Hasina?
Hi, everybody. I'm very happy to be here with you. And I have to say that everything I wanted to say has been said already, which is great news. As a bank, of course, we align our portfolios. We were happy to be one of the founding members of the Net Zero Banking Alliance. But, we were issuing our TCFD report quite earlier. And it's about to be the third edition of this transparency exercise that we're doing. So I think we share quite a lot of what has been said. More importantly, I very much agree that we need to contribute to new standards together. No one will be able to solve the impossible equation alone. So we do contribute with our peers, but also with clients, corporates in the industry, in hydrogen, in green steel. So there are many occasions for us to brainstorm and try to bring these new standards. But what is really key for me is that we all need to agree that we should not only stay on the outside, meaning excluding what is brown and only pushing for what is green, which is dangerous. And the core of our common added value will be in the middle, really supporting the economy as it transitions, meaning we need to work to support that. That's really the key for me.
Thank you, Hasina. And now, Carl Oscar.
Thank you. Well, I think we as a bank, we really need to understand our role as a financial intermediary. And that means that we are a true catalyst of change by allocating capital. But it also means that we're also very dependent on going and get funding on the capital markets. So we need to work with both sides of our balance sheet, basically. And that has been said before, but it means that we need to work with our clients. And basically what we're doing is we identify and classify those clients that have the same ambitions as we have when it comes to net zero. And we support them with advisory and lending. And we believe that right now we are basically coming into an investment super cycle. And that is really good for us in a way, but it's also a way for us to show our case to the capital market. And when we can show that we have this transition case and we are working with our clients to make this transition, we can also get much more competitive funding from the market. So for us, it's a little bit of a win-win situation when we can really show that we are allocating capital that is making change, and we can then also get more competitive funding. So for us, this is a business case by working with the two sides of our balance sheet. But for doing that, we need to set targets and we need to be sure that we have the systems in place. And I'd be happy to talk more about that later during this discussion.
Wonderful, thank you. We have spoken quite a bit about the insurance industry and how it is trying to move, especially on the institutional investment side. But within ClimateWise, we've been working quite hard over the last year to think through net zero underwriting. And in that regard, Renaud, can I ask you a question? How is sustainability being embedded into the insurance underwriting?
Thank you very much, Nina, for bringing up that topic, which is indeed very relevant, because I think, you know, as was discussed, it's a race to zero, but to run properly, you need two legs. So one of these is definitely investments on the asset side of our balance sheet, but the other one has to be underwriting on the liability side of our balance sheet. Underwriters are obviously very familiar with the risks related to climate change. We have to cope with the consequences of extreme weather in terms of natural events and the related losses. And part of the job we're doing with our client is about climate change adaptation. Just to give you a very concrete example, if you look at Hurricane Ida, which hit the US more than 1 month ago, it hit actually the coast of Louisiana and more specifically the city of New Orleans with the same intensity as Hurricane Katrina infamously 16 years ago. However, the losses were 5 to 10 times lower. Why is that? Basically because there were flood defenses built, in between. So literally barricades to make sure that we could actually improve the resilience of our communities and be less vulnerable. So that's clearly part of climate change adaptation. And I think that it's important to recognize, once again, referring to, to scientific evidence, that the IPCC concluded that human influence is unequivocally a driver of climate change. We have to take stock of that. But we can also recognize that to counteract and to offset that human influence, we can have a human impact on actually climate change mitigation. And that's the other part of the story which I wanted to stress, is the actions that we can take on the underwriting side to actually fight climate change and lower its magnitude to make it compatible with the net zero trajectory. That's precisely what the Net Zero Insurance Alliance is about. So to go into more detail, what all the founding members, and we have now momentum because, as was mentioned earlier by Eric, the leadership is really spreading geographically. So interestingly enough, the Net Zero Insurance Alliance was founded by 8 global insurers and reinsurers, but all of these happen to be headquarters in Europe, despite their global footprint and their global reach. And now we have also members from Asia, members from Africa, and I mean many others, banging on the door. So becoming truly global, also going beyond the mere risk careers, because we had the pleasure to welcome Lloyd's of London a couple of weeks ago. So we are extending our remit, and what we are doing is transitioning the portfolio of our clients in insurance and reinsurance to make sure that it's compatible with a net zero trajectory by 2050. But obviously, we don't want that to be a sort of a back-end loaded effort, where we would wait until 2049 and hope that we have at the very last minute a sort of a carbon offset, technology solving it all. We want to front load because we know that the longer we wait, the steeper the catch-up curve will be. So we want to make sure that we can take action quickly. This is why we are already working on building a set of metrics. We have tied up with a partnership for carbon accounting financials. In 14 months from now, that's by January 2023, the Net Zero Insurance Alliance will come up with a target setting protocol, following which each NZIA member will have 6 months to come up with their own targets. Progress against these targets will be reported individually by each member company on a yearly basis. And then we make sure that we have a cadence of 5 years interim target in the run-up to the 2050 ultimate objective. So as you can see, we want that to be very transparent, very granular, very credible, because we think it's key to the success of our initiative.
Thank you, Renaud. And now to bring in the banking side. So if we think about it, what does sustainable finance mean in practical terms for a bank? How are sustainability and transition considerations being embedded in particular into lending activities? And if I can throw that question to Carlos.
Well, I think as a relationship bank, we are basically defined by who is our customer. And therefore, we need to work with those that share our common goal of the future. And in that sense, we need to understand what are their goals and what are their ways of reaching those goals. So what we do and what we've been working on for quite a few years now is to classify our counterparties' transition strategies from a climate perspective. And we classify them in 5 categories, from those that are already sustainable to those that are Paris aligned to those that are not really moving at all. And this requires a lot of work. I mean, there are different tools in the market, but fact is that if you do it yourself, you really understand the data that you're getting in, and you can have very in-depth discussions with both the CFO, Treasury, and the sustainability department of your counterparties. And that creates really strategic discussions about where they're heading and how they're heading there, which provides us with both business intelligence, but also financing opportunities. And basically what we're doing is that we are integrating this understanding in both our business and credit process now. So those that have what we would call unambitious plans, they would require additional attention throughout the credit process. And that means that we are now setting up both soft and hard restrictions of clients that are not aligned and are not having ambitions to align with the Paris Agreement. So that is one part, and this is really steering capital, but it's not enough. What we're also doing, and that is on a higher level, that is making sure that we are setting targets on our credit portfolio, which is not new to anyone. I mean, we have the Net Zero Banking Alliance where we need to set targets. So in November, we will come out with targets both on how we want our credit portfolio to develop in terms of ambitions on green, on fossil, but also on transition, as we have classified or categorized our counterparties when it comes to transition. So with that, we have a way of defining, are these transactions really in line with where we want to reach with our credit portfolio in the short, medium, and long term? And then finally, and I think this is important, we cannot only have these targets, because at the moment, what we see is that since market pricing and global pricing and regulations have not really kicked in, the way we have had incentive schemes in the past don't really drive the capital the way we want. We need to create the right type of incentive schemes in the bank so that both on a division level, on a transaction level, and on an individual level, it actually makes sense to make the right type of decisions in relation to what our strategic aims are. And when we get this all together, I think we have a way of driving the bank in the right direction.
Thank you, Carlos. And that's really good to hear, because with our banking environment initiative, we've been working on how do we help client relationship managers engage with their clients and transition their clients effectively. And with that, let me come with a question to Allegra. Allegra, can you talk us through how European banks and insurers as investors are shaping sustainable finance practices globally?
So this is clearly an area where I think we as European institutions can be proud of the leadership that we've been bringing. And yes, you ask about investment, and you're right, investment activities are critical, but it's also through the engagement. So not just exclusion policies or the choice in your investment activities, but it's also through the engagement. And as Renaud mentioned, underwriting, but also the whole aspect of looking at this whole climate as not just a risk, but in fact also a big opportunity to be on the side of consumers, to be on the side of societies, to be on the side of corporations, in order to support them with the right products and the right solutions in order to undertake such transition. And when I look at Aegon, the company I work in. So when I look at Aegon, we have actually announced that we have joined the Net Zero Alliance, the Net Zero Owner Alliance. So this is an example of step-by-step, institution by institution, acting as a leader, as a role model in trying to get more and more companies to participate. And in that, I think Europe is really leading the way. When you see the membership of such alliances, there is a large preponderance of European players. And as I said, something we can really be proud of.
Thank you, Allegra. And now let us talk about how do you actually engage with clients on sustainability? So how is product innovation allowing customers to make sustainable choices? And if I ask that question to Hasim, please.
Yes, thank you. But I think first, we raise awareness of our bankers. That's the basis. And they really need to get trained, and they need to understand what are the E&S issues facing their clients. And that's not easy, because it's about the client, but it's about the sector. And more importantly, now it's becoming about cross-sectorial value chains. So it's a new ecosystem. So I think it's quite fascinating, and we spend quite a lot of time raising awareness and understanding. And that drives our bankers naturally to engage with clients on what's coming, what's going on. The basic step is, okay, we engage in sustainable finance products, which are labeled products. And it's a good start, because with KPIs and incentives, clients can show their goodwill. They can show, prove, evidence how they develop. But then it's more than that. What we do in the engagement process, we do some ESG advisory, whereby we try to explain what would be the consequences on the market access for the clients if they don't transition, or if they don't move in line with what is expected, which is not easy, because we don't have one trajectory, one methodology. So what we do benchmarking, we show them what peers are doing, and then what their investors are expecting, or what they have committed to individually. So globally, it's a kind of mapping, and then you can try and feel what would be the consequences on your access to equity and debt capital markets if you don't move quick enough. And then comes thereafter, of course, access to financing, because all the banks, as we hear, and then the insurers and the investors as well, are transforming their appetite for assets. And so that's what we do, really engaging big awareness, trying to understand the future of the company. So telling them maybe at some point, because of our own policies or because of the investors' policies, You might get stuck. So please take that in consideration to move ahead. And the extreme is we quit a relationship. When you have a pure player on some industries where we don't want to be, and there is absolutely no move into the right direction in a quick enough future. But that's the bad part of it. That's a failure for all of us, but sometimes it happens.
Thank you. And with just coming back to what Eric was saying, we've heard huge amounts of pledges and commitments and a lot of actions taking place within this COP already. What do your organizations need to accelerate your contribution to the sustainability agenda? So effectively, what needs to happen at COP now to enable you to do much more? And if I go to Allegra with that first.
So as insurers, we have a very large amount of sovereign debt in all our balance sheets. So in reality, what needs absolutely to happen if we want insurers to really be able to make a difference is that government also need to make a difference, because of that sovereign debt investment. Of course, there's only so much you can do there if the government doesn't decide to also help. And so this is really a plea to large governments to actually start really becoming also very serious on this. That is for me one of the key things. The other one is, as I said, stop vying for individual sort of single name basis posturing and attention, and actually realize that we're really in this together. And as I said, a little bit like the railroad concerted effort of the 19th century, where all financial institutions came together to really finance that massive operation, we need to look at it in the same way. Put all our strengths together, all our brains together, be willing to share, be willing to learn, be willing to cooperate with each other, so that collectively we can be winning over the climate transition, because that is what is at stake.
Collaboration and alignment. Fantastic. Renaud, what do you think?
Well, I like very much the image that Eric used earlier of a dance, to make sure that you can stir your partner and then move forward together. And it reminds me of the saying that it takes two to tango. I would add it takes three to party. And actually, I think it will take all of public authorities, regulators, and policymakers at the first bucket, the financial services industry at the second bucket, and also corporates and the underlying economy. And I think we need all three constituencies of stakeholders to move together. And, I think that I'm quite intrigued at the saying and the music that you can hear in Glasgow, which is to say, okay, COP21 in Paris was a great success for the governments because there was a great dose of coordination globally. Then maybe governments are a bit behind, so it's up to the financial services industry in Glasgow to lead the way. But I mean, what's next? Will we have to wait for the next COP31, wherever, to have the corporates stepping in? No, I think we need to act seriously and to make sure that today, together in 2021 in Glasgow during COP26, all three constituencies work together, roll up their sleeves, and we don't have, the actions ramping up somewhere just to make up for others being lagging a bit behind. So it's very important that we all roll up our sleeves together, that we get our act together, and that we walk the talk. So the financial services industry has stepped up its game, will be up to the expectations. And I think we've been able to see that across the board, very comprehensively, asset managers, banks, insurers, obviously. But there's only so much we can do if we're not supported by a robust ecosystem with policymakers and regulators pushing for greater disclosure standards. And actually, that disclosure has to be as harmonized as possible globally. We need to speak one language, otherwise it will be very dilutive in terms of effort making. And it's very important as well that the underlying economy does transform its own footprint, because ultimately our investment portfolios, our underwriting portfolio can only be a reflection of the economy.
Effectively, hard work starts now, already in 21, without waiting for any longer, and all of us together. Christina?
No, again, I'm completely in line with what's been said. So I think it's good because we really need to join forces and speak the same language. So yes, we need common methodologies. We need data, but that's linked with it, and transparency, from all actors. So, but there's a lot cooking with the regulation that will be helpful on that. So if I zoom more on a specific matter that we have, if I take the example of power, we used to finance mega projects, the 1 billion non-recourse financing. That's the way we do. That's how our regulatory models have been put, and they're based on past data. Today, if you look at power, access to electricity will not come anymore from these mega projects. We talk about small scale, very diversified assets everywhere. The risks are so different. So we need to standardize, aggregate, and distribute. But before that, we need to warehouse them, and we don't have the regulatory models. And there is probably a lack of flexibility for us to reinvent models right now. So we are faced to a new paradigm. We need to onboard new actors, the future emerging champions of the energy transition. These are not the usual actors that we have in our portfolios. We need to adapt to these new small-scale assets in different matters for energy efficiency, for power generation, biogas, and so on. So it's super interesting intellectually, but at the same time, we need to make sure that we do not distort our profitability. And profitability and generation of revenue can, if we don't pay attention, will still be from the old world if we're not equipped to push for these new models. So that's where some of the concern is today.
So effectively completely rewiring the regulatory and the financial model from which we run. Carl Oskar?
Well, I think, I agree with what has been said, but I think there is one thing that we should not really kind of forget to talk about, and that is financial markets are really good at allocating capital when pricing mechanisms work. But we have a problem today, and that is that they don't work because we have global markets where these types of externalities like climate impact are not really driving the costs. And we need to make sure, and that's about the dance and the tango or the party, that real economy policies are making sure that prices are adequately reflecting the impact on climate. Once they do that, we as financial markets will be much better at doing our job than today, because we can have so much information, but as long as the companies cannot do or don't want to do those investments because they actually will be loss making. We are seeing clients who are really at the forefront, but they're having really bad credit rating just because they over invested and didn't get paid for it. So this whole thing needs to happen, and this is the tango, and that comes back to the risks that we just heard about. There are maybe more distributed models, but there are also totally new risk models for us. We just saw a Swedish company coming out with the first fossil-free steel the other month. But they will not be decarbonized until 2045, even though they are now commercializing this. This will be investments in a very carbon-intensive company for the next decades. And so we will pump in money there, and we are talking huge amounts of money in companies that are actually fossil for the next decades, but then they will become, once they have done this large stepwise. So we need risk sharing models, and we need to find this way of distributing the risks in ways that work for society. And that's another part of this whole dance, one could say, that actually the regulators are not even allowing us to take these risks. These are more venture capital risks, but they are scaled up in those types of scales that we need to basically create transition equity or something like that to really get this more risk enabling money in there, or finding risk sharing models, public-private partnerships. So I think these are important things to really make sure that we both work with the tools that we as the financial market are really good at.
Thank you so much, Carlos. Thank you to our wonderful panel. And all that remains for me is to pass on to Michaela Köhler, the Director General of Insurance Europe, to close us.
Well, thank you very much, Nina. First, again, let me thank all speakers and panelists for their thought-provoking contributions today. And on behalf of the Cambridge Institute for Sustainable Leadership, the European Banking Federation, and Insurance Europe, I would also like to thank the European Commission for the opportunity to be part of the EU side event program today. I think we have heard today about the many ways in which insurers and banks contribute to the transition to a more sustainable society and economy. And much to my surprise, a lot of talk about dancing and partying. And I think it's a very nice, visual for what is about to happening, because when you think about sustainable, it really requires the efforts of all stakeholders. Public authorities play a key role, and we have, I think, illustrated very nicely today that while the financial sector is more than willing to play their part, we need in the end all economic actors to come along. We need ambitious and effective government commitments, and then strong individual and collective actions. And given the global nature of the climate change challenge, we need global coordination. So COP26 is essential. It is essential that all parties take these decisive actions, committing to stepping up prevention, adaptation efforts at regional, national, global level, setting ambitious targets, increasing climate finance, and finalizing the Paris Rulebook. So the COP26 challenges all areas of society and the economy to make the right choices for our world, and to make these choices now and not later. And I think this morning at least gives me hope that we can make sure to embrace these challenges together. Thank you very much and have a very nice day.
Thank you.